Hi, everyone. Thank you for tuning in and watching today. I am joined by Oliver Ternate, who is a senior vice president out of our Kidder Mathews Irvine office. Oliver, thanks for joining me. Oliver and I have done a lot of work together over the years, and I've always appreciated his approach to the market. California and the Seattle markets, we get a lot of comparisons often, and Seattle's often called the little brother of California sometimes, but we share a lot of market similarities. But one thing that Oliver does that, in my opinion, is pretty interesting, at least to me, is he represents a lot of high-tech flex tenants, which are traditional occupiers of industrial space, but they use these industrial buildings quite differently than, say, your typical big box distribution port-centric user, which, again, kind of we're looking at the Seattle market. That's a lot of my bread and butter. So I was curious what Oliver thought about that market segment in Orange County, what some of these buildings really look like on the inside versus the outside, and how tenants are using them. So Oliver, I'll maybe hand it off to you and tell me what you're seeing out there in your area and what some of these buildings look like and what tenants are doing right now.
Yeah. Hey, Matt. Thanks a lot for organizing this. Really glad to have a opportunity to spend some time talking together about our respective markets. So we've got a 300 million square foot industrial market here in my market, Orange County, which I've worked for 20 years. And it's four different submarkets: the North County market and the West County market, which are Anaheim, Garden Grove, Brea, Fullerton. Those cities tend to be more, of your traditional warehouse, distribution, manufacturing users that you're probably more used to in your market. The IBC and South Orange County, which is, greater Irvine Spectrum, Lake Forest, Foothill Ranch, they tend to have some warehouse users, some traditional distributors, but it's more gravitated towards, flex and R&D companies, engineering groups. It really kind of a hub for innovation. A lot of it has to do with proximity to UC Irvine. We've got a big depth of engineering and just innovation overall. So we had an influx of new development, new construction, just like a lot of these markets across the country did. And but what was interesting is the demand was coming from, in many cases, some warehouse users, but in many cases, R&D and flex companies. I had the privilege of representing a fusion energy company that leased a 100,000 square foot new development from LBA here in Irvine Spectrum, and the competition for the building at the time was, a satellite user, another engineering group. So it was interesting. I mean, it's sort of we've always had kind of that underlying demand from engineering and tech companies for the 20 years that I've worked the market. So yeah, I think it'll bode well for us going forward into 2024, as we've got kind of a slowdown in demand, but we've got the luxury of having not only the warehouse users, but a few different other industries that hopefully help to stabilize things.
See, and I find that so fascinating because if you look, okay, so your market, especially Orange County specifically, is very similar to Seattle in that we're land constrained. We're finding ways to get new product out of the ground, but it's tough, it's difficult, and developers are very specific about what they're trying to build. And for us, I mean, being a port-centric market, and frankly, you're in Orange County. I mean, you're right near LA and Long Beach, right? Albeit, a sub-market away. And so for me, it's, every development that we're working on, it's big box, it's distribution focused. There's really no bells and whistles added to these buildings. They're pretty generic, rectangular square buildings with small office footprint and as many docks as you can get. And I would think, and most of our landlords aren't expecting to land anything but a heavy, high cube, high flow distribution user. On occasion, we'll see that differ. But it sounds like, if I'm hearing you correctly, that on the contrary, most of the competition for these new construction buildings are these kind of high tech type engineering, doing some kind of light assembly or manufacturing in there to a degree. So I'm curious, are these, like you use the LBA building, for example, are any of these landlords on a speculative basis doing anything different with these buildings related to just how they're setting them up, from the ground up, or are they still pretty generic boxes expecting tenants to come in and tailor them to their use?
Yeah, it's more, the demand has been, just to be clear, for R&D and flex users, the demand for those users has been primarily in the Irvine spectrum, South Orange County, and the airport area. We do have, for the new construction that was developed in North County and West County, it's more of your run-of-the-mill traditional warehouse user. But yeah, to answer your question, nobody really did anything different. I mean, it was more, just deliver the Class A 30-foot clear with docks and, a real high image, warehouse building. But it's really been incumbent on the tenant, to deliver their specific, or, come in and do their specific improvements and tailor the building to meet their needs. For example, my client who took the LBA building, is gonna do a heavy scope of work, power upgrades. It's in proximity to an Edison substation, and they're going to be doing some foundation work to accommodate a machine that they're going to install in the building. So, I mean, it's really, every tenant's different. Every tenant's got their specific needs, and it is incumbent on the tenant, at least in the current marketplace, to deliver their own improvements.
Okay, so we're talking about these different buildings and their characteristics, and a big driver of these new buildings is the rent growth that we've seen, right? And especially in a land constrained market, I'm sure you're seeing crazy high land prices. Everything's changing, right? But backtrack, before these interest rate hikes and when the market started changing, land prices were really high. Landlords were expecting really high rent. I hear this deal that you're talking about, and a lot of these high tech deals, they come with pretty significant tenant improvements. And so then I think high land price, high rent, high TI dollar cost. Naturally, you wonder, it's got to be a challenge to put some of these deals together, especially from the tenant side, when they have to pay, call it the newest high rent on this brand new building because it's kind of the new higher watermark, and then do the TI on top of that. I mean, how are they getting creative to make that work? Is it an issue? I guess maybe not, right? I would imagine the income potential from a high-tech business versus a high flow distribution user, I mean, volume and margins are obviously very different. I mean, what does that look like from your side?
So I think it's yet to be seen. Over the last couple of years, it's not something that the developers or the landlords had to adjust their thinking on. I mean, it's not like they had to offer higher tenant improvement allowance or make any concessions because the demand was so high, and you had 3-4 users kind of stepping up, and they didn't really have to deviate from their sort of pro forma deal that they came into the development thinking that they would offer. I mean, so you had Rivian, for example, took a 213,000 square foot building from Panattoni right around the same time as my client leased the LBA building. And then subsequent to that, there was a group called Terran Orbital, which is a satellite, aerospace company, leased a new development from WP Carey. I mean, you had these users out there competing for buildings, and it wasn't something that was causing, even though there were tech companies that had their own specialized tenant improvement scope, it's not something that the developers had to change their course of thinking in terms of offering other concessions or anything that was above and beyond
Sure.
in terms of high dollars.
Interesting.
So how that changes going forward into 2024, I don't know. I mean, you've got, in our market, we've got 10 buildings coming out of the ground that are nearing completion, in that, call it 100 to 200,000 square foot range. And now you got some competition, right? And so if there's a kind of a slowdown in demand, not sure how developers are going to have to sort of change their thinking or thought process on that. So be interesting going forward.
Yeah, let's drill down on that. So if you're a tenant whose lease is expiring in 24 and you're out in the market looking for space right now, what kind of advice are you giving these tenants? What's kind of the general guidelines, maybe in comparison to what it's been in years past, assuming it's maybe a little different now?
Yeah, I think tenants are going to have the luxury of being a little more deliberate and not having to, encounter a situation where they're in a competitive environment with, three, four different companies for a building and having to step up. I think they're going to have more options. So it's going to bode well for them. So I think it's sort of back to what we encountered in 2008, where you had more options, you had a greater depth of landlords sort of getting more aggressive for deals. I kind of see that happening in 2024, where tenants are going to have a little bit of leverage and hopefully be able to sort of capitalize on that. So
I think that's a lot of the same that we're seeing up here. Our demand has definitely shifted. I would argue it certainly hasn't fallen off the cliff. If you look at our vacancy, we were sitting around 3% for a while, and now we're kind of up to 5.5, which is obviously by all measures, a huge uptick. But back that out into the grand scheme of things, to be 5% vacant, I mean, that's still a very healthy market, and indicates that while there's more choices, there's still not a ton of choices. So I wouldn't argue, at least specific to Seattle. I mean, it's definitely not a landlord's market, or I'm sorry, it's not a tenant's market yet. I think tenants, to your point, are going to have more options. Backtrack a couple of years ago, if you were looking at a building, you might be one of four looking at it, and you didn't really have any leverage or negotiating power. I think in 2024, that's definitely going to change. It's already heading in that direction, where we're seeing concessions tick up. Landlords are more eager to land deals versus just, we'll wait, somebody else will show up, right, if you're not interested. So that'll be really interesting to watch. Yeah, I mean, I think if you're a tenant in 2024 with a lease expiration, looking at your options, it's really going to be a great time. Historically, rental rates are still much higher. For example, if you had signed your last, assuming you did a 5-year lease in 2019 and it's expiring next year, yeah, you're probably still seeing a pretty healthy rent bump, which seems contrary kind of to everything that we're talking about right here. But you're going to at least have options. You're going to have some leverage. You're going to be able to maybe get a few more things that you wouldn't get before. So that'll be really, I'm looking forward to it. I think both from the landlord and the tenant side. On the landlord side, it'll be interesting to figure out how to get creative to land deals. And on the tenant side, to see really how much you can leverage and get out of your position, and what value do you bring as a tenant to the building, right? Because that's a big one that we never really talk about, is landlords, they look for credit tenants, right? And if you're not a credit tenant, how do you still get a favorable lease or leverage other components of your tenancy that aren't necessarily your balance sheet? So it's there's a lot of balls in the air. It's going to be interesting, to say the least.
Yeah. Hey, just curious. So in your market, in our market, we've got second generation space that's starting to become a little more relevant now. We had such a tight vacancy factor in the last couple of years as these buildings were coming out of the ground. I mean, they were getting pre-leased like that. So are you starting to see, any second generation space that's maybe, not got the level of specifications that the new product has? And how's that playing into your, sort of market dynamic in terms of price differential and, tenants gravitating towards one or the other?
Great question. And it's actually, that's a really relevant metric that we're looking at right now, because basically what we've seen here in Seattle is this big flight to quality. And I think that's pretty common across the country right now from what I'm hearing. And what that's ending up doing is these tenants are leaving these Class B, Class C that arguably might have been Class A not too long ago, but they have lower clear heights, maybe inferior truck courts, shorter truck courts that don't facilitate heavy loading. Pick your 5 metrics that might knock a building, right? These tenants are leaving those buildings, and they're really not getting backfilled right away. Before they would, because we were in such a tight, low vacancy market, the tenants just needed space, and they would take what they could get at the moment because they were competing, and it was a challenging marketplace for a tenant. Along the lines of everything that we're talking about right now, as tenants are getting more options, one, they're gravitating towards Class A and being patient to get Class A options. And two, I mean, if they are looking at Class B or Class C, it's really got to make a lot of sense in that it has to offer a discount on rent. I think that's arguably the most important if you're going to go to an inferior building. And then two, what are you doing to make that call it inferior building functional for your use, right? And there's only so much you can do to a building. It's not as easy as just, raising a roof or extending a truck court, because you don't necessarily have more land. But landlords are getting creative to try to convert some of these older buildings to make them usable for the tenant base. But I think in the grand scheme of things, what I'm seeing currently and what it's going to probably continue is I think a lot of the second generation space is it's either going to sit vacant, or landlords are going to have to offer a really attractive deal relative to comparable spaces in the market. I mean, I don't want to say it's a problem, but it's kind of a problem.
Yeah, I mean, I think that's going to be an interesting thing to watch for us here in our market as well. But the kind of the critical thing is this price differential. You got these where the new developments are underwritten based on a rent above. In our market, it's like $2 per square foot is kind of the threshold that all these new developments are kind of aiming for. You've got second generation product that it sure has maybe 24-foot clear height versus the 30 for the new stuff, and maybe has a little more antiquated office element, but they'll do $170 deal. So, I think for an R&D user that maybe in our market that doesn't need 30-foot clear particularly, maybe they'll gravitate towards the second generation product. So it's going to be an interesting sort of give and take, push pull dynamic to sort of evaluate going forward. Is what's that 30-40 cent rent differential worth, right?
Sure. Yeah, that makes a lot of sense. I've got a thought here, brokerage wise, switching from kind of representing tenants and what's going on in the market. Personally, what are you working on in your brokerage business from kind of a, call it processes standpoint, or forecasting, or just what are you doing every day? I mean, I'm curious to hear what you're looking to do in 2024 that's maybe different than what you've done in the past, because I think we're clearly living in a different market condition than we've been in this bull run that we've been going on for quite a while. I know personally I'm having to look internally at what I'm doing, and I'm planning to do things quite differently in 24. So curious what you have slated so far.
Yeah, I think kind of likening this to 2008, where you have a lot of tenants that are going to have options. It's going to be very similar to that. It's going to be helping tenants to leverage their options on a lease renewal scenario. It's going to be providing them market information and guidance, and helping them maybe look to downsize, maybe look to do a shorter term lease. I think a lot of those things that weren't in play for the last three to 4 years are going to be in play now, just based on the market and demand and availability. So I think just being relevant for my clients is going to be a big thing, and just being a value added partner. I think from the developer's perspective, it's much the same. It's evaluating the demand in the market, understanding the tenants who are out with requirements, and also understanding your competition. So I think we both got to counsel our developer clients and owner clients on how do you position your property properly? How do you position yourself for to compete for the couple deals that are out there, knowing that they're going to be having, other potential suitors in the market. So giving them advice on specifications of their building, what can they be doing to upgrade, what can they be doing to sort of meet the demand. So I think in this sort of market, we've got to use our expertise to add value. And that's totally sort of the biggest thing going into 2024.
I agree with you. I think I've always looked at brokerage as that we're brokers first, in the sense that we're negotiators and deal makers, but really, what are we dealing at the end of the day? A lot of in this day and age, it's information, right? And as a market changes, staying on top of that information and being the authority on that information and dealing that information accordingly, I think is ever more important. You'd probably agree with me that when the market's humming and you're going back to the tenant example, and you don't necessarily have a ton of options, and your business is growing and you need the space, you have to make decisions really quick, right? And it feels like things have slowed down, and you don't necessarily have to make a decision as quick. Doesn't mean the decision is any less important or critical to the, call it, financial bottom line or the future of the company, but you can be a little bit more deliberate, like you suggested. And so I know what I'm trying to do is really be more process oriented in everything I'm doing with my clients, and that really diving deep on everything that we're considering and looking at, using data, using trends, using forecasting to really make more informed decisions. Because we're at least fortunately kind of in a period now where we have a little more time to do that. And so I think, to your point, and echoing what you said, I think the the brokers that are going to do well through this changing market conditions, and the tenants that are going to want to work with them, the landlords that are going to want to work with them, the developers that are going to want to work with them, are the kinds that can see that we're spending more time than ever, frankly, being more deliberate in what we're tracking in the market and the information that we're trying to utilize for each of those various groups' benefit. I think it's going to be interesting, to say the least. I'm looking forward to it. It's a challenge.
Yeah.
Well, good. Well, let's wrap it up. Oliver, thank you for setting this up. Always a pleasure chatting with you and talking about our respective markets. I've always respected what you do down there, and California is a cool market and always gets a lot of attention nationwide. So I love learning more about it and learning more about what you're doing. So hopefully we can do this again soon.
Likewise. Thanks, buddy. Appreciate it. And all
Yeah.
of us in 2024.
Yeah, man. We'll talk soon. Take care.
Thanks, buddy.